Hey everybody, welcome back to Everything Money. We got the crew back together. The three amigos are home. Paul, we're back. And today we're talking about Logitech. Now, Paul, I know in the late 90s, early 2000s, you were buying the Logitech, the mice, all the equipment for your computer. You were buying Logitech like
Have they been around that long?
Yeah, remember
I think
mouse?
so.
Remember the mouse with the ball?
Oh, I love that.
Yeah.
Mo,
Oh, that was that
I
one?
love
The
that.
ball out playing with it.
And the next thing you know, I got carpal tunnel in that thumb, and I had to get off that Logitech mouse. But that's not what we're talking about today.
By the way, this is a great story about Logitech. Look at Logitech.
Go on.
$36 oh, no, that's...
Great story, Paul. Okay, today
That was
we're talking
actually a
about
terrible story.
Logitech, the company. We're going to use our 8-pillar analysis with this sweet radio voice to bring you home on the financials and the fundamentals behind this company. Is the stock price justified, Paul? It's a smidge high if you look at that ticker symbol.
Well, the stock chart,
Go
it was
on.
$1.40 in the late 90s, and now it's
Look at it now.
$103 a share. Wow.
And it's,
After falling from 100 and whatever,
40.
I mean, it's been a big jump.
if you're new to the channel, we're going to take a look at if you're buying this business as a whole, as Warren Buffett would say. Paul, this was the big differentiator in him and Charlie's lives, is the idea of we're not buying a ticker, we're buying a business. I keep watching old Charlie Munger interviews, Warren Buffett speeches. They talk about once you grasp the concept of you're buying a company, what do they make? What have they make in the past, and how can we project this in the future?
I'm actually reading.
Go on.
Warren Buffett gave a speech in 1978 to the University of Florida. I'm reading the transcript now.
Oh, because I've already taken notes on that one, Paul.
Oh, have you?
I love that one.
Well, it's great because he talks about when he first started buying stocks when he was 11 or 12. He looked at the charts and he was reading charts, and then he read Intelligent Investor age 19.
Ben Graham.
And he goes, "Oh my God, I'm buying a piece of a business." He's like, and that just made perfect sense to me, right?
So if we're buying Logitech, let's take a look at what they make, what they can make in the future. We'll use some of our stock analyzer tool to project out. And if you want to trade Logitech more swiftly, you can join the Bidness Nation, or not our Patreon, Paul. I keep saying that. It's going to take me a long time to get off that. But we'll talk to Mo about trading the stock a little more aggressively. Paul, let's take a look at Logitech.
Okay, so it's a $17 billion company. They have a PE of 16.32 and a 5-year PE of 39. So their 5-year PE, we want less than 22.5. That's an X. So what we can see here is they had a big surge in profit last year based on what I'm seeing right here. We don't look at profit margin as a pillar anymore, but it is 18.4%, so it's healthy. We look at a 5-year return on invested capital over 9%. Look at that 5-year return on invested capital, Seth.
Yeah, this is pillar number 2, 5-year return on invested capital, ROIC. We want this greater than 9%.
And it's 22.5%.
Very
That's
nice.
pretty solid. So we have one X and one check so far. No dividends being paid. Free cash flow. Look at this free cash flow. Last year was $1.4 billion. The last 5 years was $520. So obviously last year they had a big surge.
Yes.
COVID related of some sort. They had some big jump up. So
Paul, this is a Switzerland company. We can go visit headquarters next
well, you know, I
February.
flew back through.
Oh, did you? Geneva?
It was beautiful. No, Zurich. It was beautiful.
Keep going. Now
That's
we're going
how
to go.
pretentious as all hell. Yeah, it did.
Pillar number 3, folks, is revenue growth. How have they been doing the past 5 years?
Okay, so look at this, 2.27 to 5.8. Guys, this is a big jump. The previous year was 3.1. To jump up that high. So I want everybody to be cautious on the 1-year numbers of this company. Clearly, there was a big jump from 2020 to 2021. Was it COVID related? Probably in some fashion. And here's how I know this.
Fascist, Paul?
Yeah, fascist. 2012 was 2.3 billion. They dropped, went up a little bit, dropped, went up a little bit, went up again, up again. So they started to rebound somewhat. But guys, I wouldn't bet on this 5.7 billion being a long-term trend. I would even expect them to be dropping a little bit, but we'll look at that a little bit in the future.
I can't imagine Logitech has some sex appeal as it's the same as a new sort of flourishing company, right? It's just kind of a blah
If
company.
you look at a lot of these tech companies in this space, they did have a big surge in COVID. And I kind of talked about it in the morning show this morning. Cars are getting hurt because really hit hard with this chip shortage through 2023 because a lot of companies like Logitech, with the products they make, they took up all the chips. So that could be a big, for the reason, I mean, you can correlate that to be the big surge in
I see. Yeah,
revenue and profit
your Tesla's getting delayed. Ford, a lot of big companies are shutting
Toyota,
down.
Honda,
Shutting down their car system. So, all right, Paul. Well, anyway, anyway, let's keep going. Let's look at the profit. We
Okay,
looked at revenue.
so again with the profit, Seth, 220 million 5 years ago, 1 billion last year. So 220, 210, 265, 475, a billion. So there was an increase even the June quarter and ending June 2020. So maybe something did happen that wasn't, look at the 5 years previous, 82 minus 175, 95 minus 3 million. So, Mo, we talk about this, but even in the June quarter of 2020, which was mid-COVID,
right,
they had a big jump in earnings.
Well, it must have been everyone buying. Was that everyone buying webcams?
Yeah, I read an article today about.
Yes, that's what Tim was pointing to on his computer.
Yeah, people buying webcams, people buying keyboards for home, buying all new computers for home, which they need accessories for. So that could be a big reason for that, about the stay at home and the study from home kind of deal that was going on.
Okay, so they make webcams. In fact, my former webcam before we upgraded to a really nice camera on my desk is a Logitech webcam. So I think that's what Tim was referring to and talked about the webcam here. So there was a big jump there. Is this a permanent jump? Is it a semi-permanent? What was that?
I doubt it's permanent.
I doubt it's permanent too.
Yeah.
I really doubt that. So let's keep going.
Shares outstanding is pillar number 5, folks. We want them to be buying back shares.
But these ones are not. 163 to 168 and consistently going up year to year to year.
Sad, right?
It's not huge, Seth. We're talking about, 3% growth, increase in their shares outstanding over the last 5 years. It's not a big jump, but it's still there.
If you want the software behind Paul, you can join everythingmoney.com. We have tiers set up where you can join, get access to this information. We're selling a data feed. You can make decisions about all your investments through our software. And Paul, go into it, what you'll get for what you're paying. Go ahead, Paul.
Mobile app, 8 pillars. 30 years and more financial data, our stock analyzer tool, which is a huge hit now. Exclusive daily content will be coming to you, 1 or 2 videos a day just for our subscribers. Real estate calculator, access to all 3 of us. Retirement calculator. Discord community. Right now, there are over 5,300 people in our Discord. It's incredible. Guys, it's $27 a month, about 90 cents a day on the high side. You get all of this versus our competitors, $199 a month, $199 a month, and $35 a month. No brainer, great value play. Go to everythingmoney.com right now and sign up, and you will be locked into that price forever.
Our 6th pillar that we look at is total long-term liabilities, basically their debt divided by the 5-year free cash flow. And we want this number under 5. They want to be able to pay off their debts in the next 5.
So the 5-year free cash flow number is on the main page, $520 million. So we want their total long-term liabilities to be under around $2.6 billion. Okay? So let's see what it is. We go to the balance sheet, total long-term. Oh, holy cow.
Talk to me.
Total long-term liabilities of $210 million. Yeah! So they can pay off all their long-term liabilities in a matter of 0.4 of a year.
So this can really help us, folks, if you're following along at home. Investing in a company like this that can pay off their debts can really help them if there is another correction or some major downturn, right, Paul? I mean, this is why you were in love with CCL. They could withstand something like this.
So, Seth, one of the things I used to believe in a lot of was debt, using leverage to make money. And I still do to a certain level, but there are still responsible levels of debt that we have to adhere to. Logitech has $200 million in long-term liabilities. $200 million. That is nothing. They can pay it off within 5 months of their free cash flow.
Yeah, that's amazing.
That's phenomenal. So their goal is to operate a really good business and get returns on their returns on invested capital. That's pretty solid.
Pillar number 7 is the granddaddy of them all, free cash flow growth. We want this going up, of course, Paul. We want it growing.
Okay, so in the last 5 years, they went from $256 million.
Look at that.
To $1.4 billion. That's a check mark with an average of $520.
So are you throwing out last year and just calling this average something around $300 million in free cash every year?
That's probably a good idea, Seth. So we probably want to focus on. Now, to the metric side, we still want to focus on this 520 just to keep it consistent. So 520 times 20 is about.
Come on.
$11 billion.
Oh, okay.
Is that what it is? $10.4 billion.
The market cap is $17 billion.
So it's a little expensive there from that regard. So that's an X on the price of free cash flow being less than 20.
That was our pillar number 8, folks. We multiply free cash by 20 to get a desired market cap, and the actual market cap is a smidge high at the moment.
Yeah, but to Seth's point, which he brings up, whenever there's look at CCL. Mm-hmm. We don't focus on the last few years of CCL. Why? Because the last couple of years have been COVID related. We're going to focus on CCL's ongoing business when things are normal. Same with Logitech. This last year is a fluke. I would throw this out. Could it be a new baseline for them? Could they all of a sudden could everybody be buying webcams like crazy and upgrade? It could happen, but I'm not going to make an investment based on 1 year that can be accounted for off one event and have that 1 year it's like buying Clorox based on last year.
Yeah.
You know, Clorox is going to do amazingly well, and I haven't looked at their numbers, but this is probably run just like Zoom. Zoom had a huge surge. Now, I do think Zoom is going to be used more and more, but that surge they had is probably going to dissipate a little bit because even internally, we're using Zoom less. Why? Because we're face-to-face now. We don't need to use Zoom as much. Same thing here with Logitech. I would focus on these 4 years or including the 5th year there when determining an average of the 5 years free cash flow.
Paul's going to pull up our stock analyzer tool to show you what you should be paying for this if you're looking for a great return in the future. In the meantime, we will head over to Mo. Mo, are people trading Logitech? I can't imagine the volumes that's smashing.
Yeah, that's a good call. I'm going to point that out first. Look how low the volume is. I mean, your average volume is probably maybe 1 million shares traded per day. You can look it up on anywhere, to be honest with you. But right now, it's just, if you just draw a straight line there, you're just sitting at a support point. So that's good news. The other point of good news is that gap down that it had a couple of weeks ago, maybe August. So gap's always typically 90% of the time filled.
Yep.
So this thing, if you just let this ride on the bottom, it's a dog stock. We talked about that earlier today on the morning show. Dog stocks, they get to the bottom, they sit there, they drift for a long time as the price declines, and then you're going to be the first one into it when it gets in the sweet spot. It'll likely fill that gap. Maybe you'll get up to those highs, but the gap is more likely to fill than anything. Just be careful with that low volume and being under all 4 of your major moving averages. This is going to be a tough one. You're going to need some kind of volume to come in here in some fashion.
If this nonsense sounds crazy to you, you can join the BidNAS and join Mo on a daily basis where you can learn the ease of trading. Mo, Beth and I, my wife, talk about this is my future trading with you. As soon as I can share up everything in money, I'm going to be trading, see my stochastics. There are rules you can follow. This is not gambling, folks. No. Follow Mo's rules and you can start slaying it with him as well. Yep. Paul, what are you putting over there in the stock analyzer tool? We'll look at how to predict what we should be paying for this stock.
So here's the hard part, Seth.
Go ahead.
They had a huge jump in revenue, and our stock analyzer tool...
It's going to take that into account?
It's going to start from a baseline of that number in revenue. So it's kind of a hard thing to do right now for our stock analyzer tool. Our stock analyzer tool is really good for companies that have a stable growth level and don't have huge jumps in profit and revenue recently. Over longer periods of time, if you see these jumps, this is what matters. So if you look right here, the revenue growth in last year jumped up 84.5%. So if this is our new baseline, how much is it going to grow? I don't know. This is the hard part about the stock. But the great news about the stock analyzer tool is it can take this jump and see if it's a reasonable number even today. So I am putting in some what I consider to be fairly reasonable assumptions in terms of what I want our levels to be. So PE, for example, it's not really a sexy company. So
the current PE is 16.
The current PE is 16, but the 5-year PE is a lot lower, a lot higher.
Yeah.
So I'm putting in these numbers here. What's best to focus on in the stock analyzer tool is where does the company stand based on even the rosy assumptions that happened recently with Logitech. I hit the analyze button, overpriced. It's already showing me on all levels it's overpriced here, right? I usually try to buy somewhere in the mid-level, which assumes a 12.5% return. So we need to be between $35 and $55 a share.
Yeah, the current price is 102, Paul.
And that's with our huge jump at 84.5% revenue growth last year. That assumes it doesn't pull back at all. So let's go look at the income statement. And let's go to the quarterly look. So the most recent quarter was June of 2021. They did $1.3 billion. In June of 2020, they did $791. But look at this, guys. Look at their revenue. $792. 1.26, 1.67, started to see a drop, right? So I look at this going, as an example, between December of 2019 to June of 2020, there was a drop of revenue from 902 to 791, even though this was the start of the big quarter of jumps.
Yeah, look at that.
You know what I mean? So I look at this saying, how do I feel about this? I just think this is a declining revenue source for a couple. Does that mean it's just going to decline forever? No, but it's going to get to a more stable standpoint. Is Logitech a great company? I've never had a problem with any Logitech devices I've ever used. I've always loved them. So that's a good thing, But just from a standpoint of where the economy was and what type of economy we were in last year, I think you need to exhibit some caution in terms of assuming that last year's numbers are going to grow from here. I personally don't believe that. As a value investor, I don't want to make the rosy assumptions and buy on the rosiest assumptions. I want to buy on reasonable assumptions or conservative assumptions. And if the price is still where I want it to be, I would be buying.
Oh,
so,
I know you own all of Logitech's complete line of sex toys in your
I love the
master
ones with the cameras on them, so you can like.
Oh, do you?
Yeah, so not only is it for sex, it's also for colonoscopies and things like that.
Oh, great,
home
great,
colonoscopy kit.
If you like the way we look at companies, you can join the Everything Money community, everythingmoney.com. Fondle that thumbs up on the way out. Paul, the mindset of like, I only get 20 punches in a lifetime to invest. This is not
That's not my mindset. That's Warren Buffett.
This is not a screaming deal, though.
No.
You're certainly avoiding the stock.
I think the stock needs to fall in half before I'm even taking a look at it at best.
And if that sounds bonkers, folks, that happens all the time. It's currently happening with a lot of other companies that we're investing in at the moment.
Well, and here's the other thing, Seth. Remember, the company is selling for 16 times earnings on their best year ever. That was a massive jump because of COVID.
Yeah.
So it's not. So that's what you have to remember when you say, "Oh, can it really fall in half?" Like if the revenue just starts to look, the revenue is already decreasing every single quarter the last few quarters. Why? Because we're getting back to the offices.
Yeah.
Right. So just keep that in mind. This is not a negative on Logitech. It's just that's the way it was. They surged because of COVID, and now that COVID is coming, now that COVID people are back in the offices, we have less need for cameras. Yeah. Why? Because we can just go to each other's office and say, "Hey, what's up, dog?" And that's it. And you have your meeting.
Tickle the thumbs up on the way out. See you next time. Thanks for watching the video. Love you guys.